Now that you understand how liens are created and attached to property, it's time to explore how they interact with one another. When multiple liens exist on the same property, priority determines who gets paid first if the property is foreclosed or sold. Priority can drastically change the outcome of a sale and determine which lien holder is made whole and which may lose their claim entirely. Understanding lien priority. Every lien recorded against a property has a specific position in line known as its priority. The general rule in property law is simple: first in time, first in right. This means that liens are paid in the order they were recorded, with earlier liens taking priority over later ones. However, there are exceptions to this rule, especially for superior liens, such as property tax liens or certain mechanics liens that, by law, move to the front of the line. For example, if a real estate tax lien was recorded on June 15th and an income tax lien was recorded on June 1st, the tax lien from June 15th still takes priority, even though it was recorded later, because state law grants real estate tax liens superior status over other types of liens. Among junior liens, the order of recording matters. Suppose a judgment lien is recorded on Friday and a mortgage lien is recorded the following Tuesday. The judgment lien takes priority because it was recorded first. In foreclosure, the property must first satisfy the judgment lien before paying off the mortgage lien. An important exception applies to mechanics liens. Under most state laws, including Arizona, the priority of a mechanics lien does not depend on its recording date. Instead, it often relates back to when work first began or when materials were first supplied. This rule protects contractors and suppliers who enhance the property's value, ensuring they aren't disadvantaged by late recording or slow payment. Let's look at an example that shows how lien priority works in real life. A homeowner is foreclosed upon after defaulting on a second mortgage taken out in 2001 for $25,000. The first mortgage, taken in 1997, still has a $150,000 balance. The homeowner also owes $1,000 in unpaid property taxes and has a mechanics lien recorded in 1999 for $3,000 for home improvements. The home sells for $183,000 at foreclosure. The proceeds are distributed in this order: $1,000 for real estate taxes, $150,000 to satisfy the first mortgage, $3,000 for the mechanics lien, $25,000 to pay the second mortgage, $4,000 remaining goes to the homeowner. This example highlights how lien priority directly affects the amount each creditor recovers. The second mortgage lender, in this case, was in a risky position. If the property had sold for even slightly less, say $179,000, they would have received nothing. Subordination agreements. While lien priority usually follows strict rules, lenders sometimes agree to subordinate or voluntarily lower their lien position. This typically happens when a homeowner refinances. A new first mortgage lender will not originate the loan unless it holds the senior position. Therefore, the existing second mortgage holder must sign a subordination agreement, agreeing to take a lower priority position behind the new first mortgage. For example, imagine interest rates fall from 8% to 6.5%, and a homeowner wants to refinance their existing first mortgage to take advantage of the lower rate. However, the homeowner also has a home equity loan recorded after the first mortgage. The new lender will only refinance if it retains first position, so the home equity lender must agree to subordinate its lien to the new first mortgage. Without subordination, the refinance cannot proceed. Superior liens. Certain liens automatically hold priority by law, regardless of when they were recorded. These are called superior liens, and they always get paid first. The main types include real estate tax liens, created each year by local taxing authorities as security for payment of property taxes. These are also called ad valorem tax liens, meaning according to value, because the amount owed is based on the property's assessed value. Special assessment liens. Local governments may impose these liens to pay for neighborhood improvements like new streets, schools, or sewer lines. The lien only applies to properties that benefit from the improvement. Inheritance and estate tax liens. These arise when taxes are owed on the estate of a deceased person. They attach to both real and personal property until the taxes are paid. Junior liens. Junior liens are all other liens that rank below the superior liens. They include federal income tax liens filed by the IRS when a taxpayer fails to pay income taxes, state income or corporate tax liens filed when individuals or corporations fail to pay state taxes, franchise and intangible tax liens, imposed to collect unpaid state business or intangible property taxes. Lis pendens, notice of pending action. A lis pendens, meaning suit pending, is a recorded notice alerting the public that a lawsuit has been filed involving the property. For example, if a neighbor files a lawsuit disputing a property boundary, they may record a lis pendens in the county recorder's office. This warns potential buyers or lenders that the property's ownership or title could be affected by the lawsuit. Until the issue is resolved or the lis pendens is released, the property's marketability is significantly reduced because any buyer takes the property subject to the court's eventual ruling. Judgment lines. A judgment line results when a court awards money damages to a creditor who hasn't been paid. The lien gives the creditor a legal claim against the debtor's property, even if the debt has nothing to do with the property itself. For instance, if a person personally guarantees a business loan that later defaults and the lender wins a judgment in court, that lender may record a judgment lien against the guarantor's home. The lien remains until the judgment is paid. Once satisfied, the creditor must issue and record a satisfaction of judgment, confirming that the debt has been fully paid and removing the lien from the public record. If the debtor fails to pay, the creditor may obtain a writ of execution, authorizing a sheriff to seize and sell the property to satisfy the judgment. However, this is rare because senior liens, high costs, and homestead exemptions often make execution impractical. Consensual liens. A consensual lien is created voluntarily by agreement between the borrower and lender, typically when securing a loan. A purchase money security lien arises when a creditor provides funds to buy the property itself, such as a home mortgage. A non-purchase money lien uses property the borrower already owns as collateral, such as a second mortgage or line of credit. Statutory liens. Statutory liens are created by law, not agreement. These include mechanics liens, filed by contractors or suppliers who have not been paid for work or materials. Warehouseman's liens, filed by storage facilities for unpaid storage fees. Tax liens, imposed by government agencies for unpaid taxes. Municipal utility liens, recorded by cities for unpaid utility bills. Vendor's liens, created when a seller finances the buyer's purchase of property and retains a lien until the loan is paid. Mechanics liens and Arizona's 20-day preliminary notice. In Arizona, anyone who performs labor, provides materials, or supplies equipment for property improvement has the right to file a mechanics lien. However, they must first file a 20-day preliminary notice to preserve that right. This notice informs the property owner, lender, and general contractor that the claimant is part of the project and expects payment for their work. The notice must be sent within 20 days of first furnishing labor or materials. If sent later, it only protects lien rights for the 20 days preceding the notice date. Best practice is to send it immediately after work begins. Notices are typically sent by certified or registered mail, and the sender must retain proof of mailing or service. If unpaid, the claimant can record a mechanics lien, but the lien's effective priority date relates back to when work began, not when the lien was recorded. For example, if a contractor completed work on May 15th but didn't record the lien until August 1st, the priority date remains May 15th. This ensures fairness to those who contributed to improving the property's value. Summary: lien priority determines who gets paid first when a property is sold, and it's essential for protecting creditor interests. Superior liens like property taxes and special assessments are always paid first, followed by junior liens based on recording dates. Subordination agreements allow lenders to rearrange lien priority voluntarily. Judgment liens, lis pendens filings, and mechanics liens all affect a property's marketability and title status. In Arizona, the 20-day preliminary notice is vital for contractors and suppliers to preserve their lien rights, emphasizing the importance of early communication and documentation in real estate transactions. Discussion: why do property tax liens always have top priority over all other liens? Answer: because they fund essential government services and are automatically imposed by law each year. How does a mechanics lien differ from other junior liens? Answer: its priority relates back to the date work began, not the recording date, giving it a unique advantage. What purpose does a subordination agreement serve in refinancing? Answer: it allows an existing line holder to voluntarily lower its priority so a new lender can take first position. Why is Arizona's 20-day preliminary notice important for contractors? Answer: it preserves the right to file a mechanics lien if payment issues arise and promotes transparency among project participants. Closing remarks: understanding lien priority is crucial for protecting property rights and ensuring fair financial outcomes in foreclosure or sale. Whether you are representing a buyer, seller, or lender, knowing which liens come first and how they can be modified or released is essential to maintaining clear title and preventing costly surprises.